CNBC TV18 presents Commodity Classroom, Bullion Derivatives, Tools for Risk Mitigation and Organized Investment.
Hello and a very warm welcome to this special series that we have with MCX, and it is Commodity Classroom. It's a Dhanteras special and it's a very auspicious day really, because this is the time wherever you are, if you're an Indian, whatever you do, there is gold buying that happens here. Well, clearly this year we've seen that a lot of gold buying has shifted online and towards paper gold as well. We've seen some records breaking this year, whether it has been about the gold prices itself or the gold buying on ETF, gold trading on the derivative markets on MCX as well. The volumes clearly are at historic levels here as well. So that is exactly our theme today, and we have an esteemed panel to begin with that will talk about the risk management for value chain participants via the exchange. I will introduce my guests to you. We are joined by Mr. Prithviraj Kothari from Riddhi Siddhi Bullions Limited. We have Mr. Dilip Narayanan, who's from Malabar Group of Companies. Mr. Gaurav Mathur is from Safe Gold, and Mr. Shivanshu Mehta joins us from MCX. Gentlemen, thank you so much for joining us, and a very warm season's greetings is what I'm extended to all of you. I want to start with you, Mr. Kothari, and while it has been a very phenomenal year, we've had the US presidential elections, we've also seen the COVID impacting the industry and prices and the sales as well. How would you look at this year, the kind of volatility that we've seen, and how would you look at the hedging mechanism, which clearly needs to be put in practice?
If you see in the lockdown from the March, thereafter the lockdown started, and then suddenly people are afraid of the everything. They never seen such type of situation in the history of life there. No one can see. So again started, people are afraid and they buying their savings. They are focused their savings. Mainly they focus what the savings now we have, because everyone is affected from the penny of a rupees. After that, some started because the equity market and the stock market is open. So lot of people are buying the gold ETF. The huge quantity of ETF buying in the gold in both the exchanges, NSE, BSE, and also and secondly, then after that started the government selling the gold sovereign gold bond. So gold prices are all-time high, and demand should be also high. So now it's the same situation still are running there. The people still are buying gold, and those people buying gold, there is a large scale people are buying gold. They have always been against the gold, because gold is the dead investment they are telling, but this time they are buying gold in their portfolio. So that's the reason behind that the gold imports should be slowly pick up, and then now it's the lockdown is over. The demand, the import figure, everything should shoot up. Everywhere is a huge demand of a gold, jewelry, either if you say in the bullion or in the coin, everywhere is the demand.
Well, absolutely, yes, even as the prices are rising, and as you were telling us just before we started on the show that people are not really looking at prices. Investors do want to lay their hands on gold in whichever shape and form that they can, because the expectation is that gold prices could go higher from here. But the point is that the volatility on the gold prices has been very high, and how do you hedge gold prices? That really is the big question, because on some days in this year, we've seen the gold prices move anywhere between 2 to 7% on the higher side as well. Dilip, this question is to you. How would you look at the exchange? How would you make use of the exchange to ensure that the product or the physical holdings are hedged well?
For us, the retailer, it's an insurance against the rate fluctuation. While for the customer, it's benefit if it is appropriately managed. So we have recently started out our bullion trading also along with the retail part, and MCX rates gives us a very good indicative market play rates. So what we have noticed is that, Manisha, that many of the jewelers, not large players I would say, but do not take into consideration or do not look out for options to insure themselves from rate fluctuations, mainly due to the fact that they are unaware of such products, or this needs to be campaigned. And this needs to be campaigned well locally. That's what I would insist on. South India, especially in Kerala, where there are a cluster of retail jewelers, they are totally unaware of such, and the reason behind this is mainly due to the fact that the futures is not made well aware of. Okay, so if this campaign would go into the rural areas of southern India, it would really benefit the small players too. I'm talking this excluding the large players who are very well aware of the entire system. To take the benefits of gold futures, since it is same throughout the country, we have introduced one India, one gold rate across the country as well. You guys would have seen that the advertisement and the campaigning which is gone. So we have now one single rate across the stores. We have almost 120, 115, 160 stores in India, and the rates are one across the board. So this way, it all enables us to efficiently hedge our stock and schemes compared to different rates in different cities, making it cumbersome to record.
Shivanshu, how would you look at this market?
Yes, we have seen it reach to a certain level over the past 3 years. Recently in March, it hit an all-time high open interest of around 9 tons. So definitely there is some level of presence already which needs to be further maximized. And the other thing which you'll notice, as Mr. Kothari said, that during this lockdown, the precious metals asset has seen a lot of retail interest. So from that retail awareness point of view as well, we have recently launched the gold petal 1 gram contract as well as the silver mini micro, both of them which are deliverable with a 1 kg silver bar. And you will be surprised to know that there has been a tremendous response to these products. They have seen a delivery of 21,000 1 gram coins, and about 22 tons of silver has been delivered via the 1 kg silver bar alone. So this retail, play out which Mr. Kothari outlined globally has also been seen domestically, and we are happy that these two innovative products, gold petal being the only such product in the world, we are happy to see the retail portion, also the retail investors utilizing these.
Well, absolutely, yes, and the markets are looking forward to that since it has been cleared, and since yours is an exchange which has the major highest volumes as well, this inclusion clearly would change the way the Indian markets work. Gaurav, let me come to you, and it's all about digital gold when one speaks to you. How are you looking at digitization of gold and the way the exchange works? How are you looking to marry the two, and how is the hedging mechanism working well for you with the exchange itself?
Sure. So we are called digital gold, but we are a purely physical business, as in all of the golds that we sell digitally. It's all backed up physical. I think the MCX plays an extremely valuable role in our functioning. It serves two purposes. First, it serves as a price benchmark. It is a future, but for better or for worse, there is physical prices vary across the country for the most part, and the MCX is the most reliable benchmark that one has for a price. So I think just as a price signaling benchmark, it serves as a very important purpose. Also, through the lockdown especially, supply of gold has been constrained often, and physical movement has been restricted. So we use the futures both on the long side as well as on the short side to hedge our exposure when we cannot complete all of our requirements on the same day in the physical market. We use the MCX, and I should say that in the last 6 months, overall volumes have also shot up quite a lot. But our use of the exchange has also gone up dramatically, simply because there is a lot more volatility in the market, and one is price volatility, but there's also volatility in physical supply. Either you have too much of it or you have too little of it. And for both the price as well as for the physical supply, the exchange serves an extremely valuable role in managing our.
Well, absolutely. From a time when we used to say that trading on the exchange perhaps isn't the right way to do it, but if you're not hedging, you perhaps are still dealing big and gamble there. So yes, the price volatility is huge, and the way the moves are, I think it's very primary that whatever exposures that you have in the market need to be hedged. Gentlemen, thank you so much for joining us, and thank you so much for answering all of those questions as well. Mr. Kothari, Mr. Narayanan, Mr. Mathur, and Mr. Mehta, thank you so much. We take a short break. When we come back, we have another segment planned out where we will talk about the exchange mechanism for benefit of bullion and the jewelry industry. Stay tuned.
MCX and CNBC TV18 present Commodity Classroom, Bullion Derivatives, Tools for Risk Mitigation and Organized Investment. MCX and CNBC TV18 present Commodity Classroom, Bullion Derivatives, Tools for Risk Mitigation and Organized Investment.
Welcome back, and you're with us on Commodity Classroom, and a very happy season's greetings to all of our guests, viewers and participants here. It has been a roller coaster year as far as the gold prices go. Well, we've seen all-time highs not just in India but 69 other countries or currencies as well. So much more important that you hedge your exposure and that you also have gold in your portfolio, because gold has been one of the best performing asset classes in this year as well. So we will delve into all of that on what are the available products, instruments, etc., where you can have your exposure into this one. Joining me on this leg of the show is Mr. Chirag Thakkar from Amrapali Industries Limited. I also have Mr. Pareen Sangvi, he's from Raksha Bullion, Mr. Saurabh Gadgil from P.N. Gadgil Jewelers, and Mr. Shivanshu Mehta from MCX. What we are talking about on this segment is the exchange mechanism for the benefit of bullion and the jewelry industry. Gentlemen, thank you so much for your time with us. Mr. Thakkar, let me start with you first. And there are various instruments available when it comes to trading. There is futures, there is options, and there is now index trading also available. Would you say that you are now well equipped when it comes to hedging your exposures to the physical markets there?
See, Manisha, actually, before there were a lot of class of people who actually didn't wanted to hedge their exposure. But since last 1 year, the kind of appreciation which gold prices have seen, now people have started being so aware about to price and risk their bullion position, their jewelry position. Now, at the same time, if you see MCX is coming up with so many new products, started with options, gold options, good options. At the same time, the exchange is actually trying to get small jewelers as well into the same platform, which actually makes it more viable for them to mitigate the risk. Ultimately, the kind of a volatile market we have seen in the last couple of years, mostly last year, that is, we have seen more than appreciation more than 40%. And when you're on the right side of the volatility, you feel really good. But when you're on the wrong side, you actually realize that now it is the right time to enter into kind of a products where your whole risk of your inventory, being a jeweler, being a bullion, your whole value chain is being hedged in the exchange in MCX.
So, Shivanshu, while every time we talk, there is always this conversation on how many more products the exchange has kept on adding. So why don't you just quickly list it out for us, all of them, before we get any forward in this conversation?
Sure. So we have all compulsory delivery products in gold and silver. In the case of gold, we have the kilobar contract, which is the benchmark and seen as the domestic price reference point. We have a 100-gram contract, where the delivery is 1/10 denomination, as well as the deliveries of the 100-gram bar. We have the 8-gram coin, the Guinea contract, and we are the only exchange in the world. It's a record that we have a 1-gram gold petal, 1-gram deliverable contract. That's the only one there. On the silver front, we have silver 30 kgs, which is the benchmark. Then the silver 5 kg, which is silver mini, as well as the silver micro, which is the 1 kg. They are both settlable, or the delivery lot is the 1 kg silver bar. So these are the products. On the option side, we have the kilobar options as well as the gold mini recently launched option in goods, and we have the silver 30 kg options, and the Bulldex, which is doing rather well, launched on the 24th of August, which is an index of gold as well as silver futures.
Shivanshu, why don't you catch your breath, because that was a long list that you put out there. Saurabh, let me come to you now. So when we talk about the product availability, and as Chirag very rightly put out, that if you compare to where we are and where we were a couple of years back or 5 years back, there are more and more people who want to come to the exchange. There is one product or the other which actually they can identify with and start hedging or trading or investing in with. But Saurabh, this one is to you. According to you, how do exchange-based futures and options benefit the retail jeweler houses like yours, and especially in a peak season like Dhanteras and Diwali?
Like you mentioned right now, every jewelry chain today, even be it like a smaller chain, bigger chain, regional, national, needs to hedge its entire stock today. It's not only a need of the business; it affects your P&L directly. It's a need of bankers. It's a need of your partners. And so hedging, has become an imperative of the jewelry business today. There are, like I mentioned, MCX has a plethora of options and futures products for the hedging mechanism. And especially during festive time, the jewelers have a lot of schemes for our customers wherein we give them options of fixing prices at any date of the purchase, so they can book in advance and fix prices later. We have options wherein they pay installments monthly and they buy at a later stage. So the entire price risk is on the jeweler, and he has to be able to hedge the price risk. This also helps us to really plan a capital well. By paying say 5-6%, you are able to cover your entire price risk. All these products are based back by delivery, so worst come worst, you can take the delivery of the product. And I think what it does is it gives us a platform wherein we can be very customer friendly and help us to block sales in advance to ensure that the festive days, the buying is already pre-booked. It helps the cash flow. And in today's environment, this year we have seen specifically the entire jewelry industry focus has moved away from discounting to price fixing. So every jeweler has an offer by different names wherein you are giving a customer the benefit of picking up jewelry at his booking price or the price which is lower. So for us, this has become very imperative, and these products which are backed by delivery also gives us a safety cushion. And the kilo option, 100 gram, mini, there are various parameters here, and the best part is it has a lot of liquidity. For any option, you need to have buyer side liquidity, which is there on MCX. So I think we jewelers are very happy with this. And be it futures or be it options, we are using all these products because now they become an integral part of the industry. On one side, the designs, on the other side are these products which make today the jewelry trade. And this is going to be staying for long because now we know gold is in an era which is going to be volatile, a lot of price movement, a lot of flexibility is needed, and we also have to support our bottom line by ensuring that we don't lose margins from the gold price movement on either side.
Absolutely. Saurabh, you actually put it all around, summarized it very well. So when jewelers are offering all of those kind of offers and schemes and a year-long offers as well, and as you said, there is an option for the buyers to actually offer the lowest price in a day or book at the lowest price of the day. The jeweler as well needs to hedge it in some sense or the other. Praveen, this one is to you. So when we talk about the spot futures, spot prices, and we look at the future prices, what has been your sense and your experience on the convergence of this?
So how jewelry has its own mechanism to use the platform, billion people have this own style. So as I've always said in the last time also that we have a duty fluctuation every 15 days happening. So by using MCX hedging as a tool, we can always hedge our duty. And whenever we import our stocks or whenever we buy from any refiners or import our durates as well, that time we hedge all our consignments or all of our inventory which is going to be processed in the next 12 days in the exchange. So for example, if there is any fluctuation, the MCX takes all the fluctuations into account and accordingly it moves. So it helps us while when we are quoting our clients, our jewelers or semi-bullion dealers, that time we don't get the hit of any duty movement. At the same time, international events, recently there was a big event of American elections happening. So that time we expected prices to move in a big swap up and down. So that time it really helped for all us because whenever we import, and plus the event came during the Diwali season. So that time we could hedge our stock completely on the exchange and also play some option trades to hedge the duty swap against it, and it helps us in providing the right prices at the right time whenever the trades are welcome to us.
Gentlemen, thank you so much for taking time out for us. Happy festivities to all of you, and with that, that's all the time that we have. Thank you for watching.
MCX and CNBC TV18 present Commodity Classroom, Bullion Derivatives, Tools for Risk Mitigation and Organized Investment.